Here's the important thing to note, which is that if you look at the MAU growth of Snap, it's actually been extremely steady. And they've had an incredible march forward, and I think that they're roughly around 350 million. It's a service that is incrementally every day more relied upon than the day before. And it's a service that's providing a set of features that is incrementally more important to a larger and larger group of people. So how do you then square that with its stock performance? And in my opinion, I'll just be really honest with you. And I don't know Evan Spiegel, and I've never trafficked in Snapchat at all, okay? But it is the most glaring example of corporate misgovernance that has ever happened on the internet. And the reason is, when you look at what happened in the IPO, it basically created a governance structure where the common shareholder had all voting power taken away. So 100% effectively, the de facto voting power stayed with the class that was held by the founders. And so you do not have a normal check and balance. And it was egregious. Other companies would have voting programs where it was 20-1. And you would sometimes say, oh, it only should be 10-1, or it should be 50-1. This was like 100-0. And what you have now is no real feedback loop, because there is no person who can own enough equity with enough say to sit across the table from that CEO and say, here's what you're not seeing, and here's what you're getting wrong. And I think you're always better off by having those kinds of people be able to get a meeting with you in the first place and have a vested interest where you take them seriously. But how would you receive a meeting when you're sitting across the table from somebody? In the back of your mind, you're like, wow, this person has literally no say in what I do after this meeting ends. Literally none. You can't vote even. To even zero, actually... I think zero is, in my opinion, a deep sign of disrespect. I really think that stock prices tend to ebb and flow based on like friction or momentum. And when there's momentum, more and more people can easily underwrite it. And when there's friction, fewer and fewer people can underwrite it. And so I think that if you are a CEO of a public company, you have to think about, how many headwinds do I have and how many tailwinds do I have all the time? And some of them are in your control and some of them are not. At least in the case of Meta, as with Apple and Google, Meta is forced to copy the best decisions of these bigger companies. Why? Because they were one of those biggest. Now, they may have been the smallest of the biggest, but it's going to be very hard for Meta eventually to not converge on those same set of decisions. And the most important one is what Brad just alluded to, which is that there was a point in 2016 and 2017 where you literally could not give away Apple stock. And the big turn of the dial, and some say it was Carl Icahn, who knows, was this theoretically this famous dinner that Carl Icahn had with Tim Cook, where he laid out a plan and it's, listen, you need to start managing costs better, managing OpEx better, return a ton of cash, buy back the stock, and you'll be a darling. And Tim Cook was rewarded. And he's been rewarded with an incredibly performant company. And Google is slowly inching towards that plan. Microsoft is in that plan. And so the only big four horsemen that hasn't really gotten the script yet is Meta, but they will. We're just debating when. And so there's a perception that Meta will copy what the rest of these big guys do. But these other long tail companies, the headwinds are just greater. And so when you don't have a company that can be broadly owned by intelligent, thoughtful investors, that's a headwind, right? When you give nobody votes, that's a headwind. And so that's why you see a company that's continuing to grow impact, not being able to translate that into economics. And if I were the board of that company, that should be a wake-up call, because eventually that'll flow into the morale of the employees and the ability to retain, and then the ability to invest in the future. And I think the simple answer is enough with all these gymnastics around control. If you looked at Elon, the most incredible thing from day one was there's common stock. And his whole thing was like, I'm just going to do the best. And you know what? If I'm not the best, I'm going to be out. He's never, ever played these games. So in this funny way, control is a symbol of a lack of ability to run the business. Masterful mastery of a business, you can translate that to being, I'm just going to have common stock.
Back to the governance question.
I think that you can correlate these kinds of governance overreaches with zero interest rates. That dog doesn't hunt when rates are at 4 or 5%. I don't care who you think you are, but when you try to go public over the next 4 or 5 years, if rates are sustained 3, 4, 5%, that will be the check on all of these people's overreach, because you will have liquid alternatives that on a risk-adjusted basis seem better. And when rates are zero and everybody was forced to own tech, we all gave up our standards. We all stopped saying, oh, the things that we used to think were important before, like one person, one vote, a check between the board and the CEO, a check between the executives and the shareholders. It all went out the window because when interest rates are at 0%, you have to remember, how does the structural basics of the financial markets work? It is meant to make money on behalf of every single entity and person and thing in the world, from a pension fund to a university to a research lab to a government to an individual. But in that ability to make money, when we took interest rates to zero, 40% of what we all used to own, bonds, yielded nothing. And so we just completely whipsawed to the other side and said we need to own anything that grows. So tech got a disproportionate amount of attention, but in that we lost our standards. And we are now going to go through the hangover of dealing with it. And Snap will be an example of where investors are going to abandon that company. Because it's just, there's no point. There's no governance. There's no ability to have a conversation. It's in the too hard bucket. So people will just leave it. It'll be stranded and it'll be a refugee in the public markets. I think Meta will be fine eventually, because I think that they will revert to the mean. And the mean is Microsoft, Google, and Apple. And we already know what that playbook looks like. So I think what Brad predicts is more likely than unlikely. And I think in the future, to David Friedberg's point, I think it'll be very hard to justify these things. Bankers will be able to push back, because the buy side, ultimately, guys like us who have to buy the stock when these things go public will say, nope. You want to have these dumb governance games? No, not for me. I'll just go buy something else. I'll go buy more Tesla where it's one person, one vote. Why? So it's hard when the best CEO in the world is judge me, keep me, fire me on an equal basis. And everybody else is, I'm smarter than this guy. And you know what? Let me make sure that whenever I feel like it, I can throw a temper tantrum and take my toys out of the sandbox.
And let's use there's an analogy here.
It doesn't work. There was a person at Brad's Investor Day who Brad interviewed, and I won't say his name, but he's a star of stars. He's a bit of a goat. And he had, and I'll just say the generalized version of what he said. It's like, we've gone through an entire decade of under-training an entire generation of people in Silicon Valley. We have under-trained and under-mentored the product managers, the engineers, the senior executive management, the CEOs. Many of these people, unfortunately, they don't have the skill set to execute at a high level at any point in the cycle, except when rates were zero, like many business models. And now that rates are not at zero, these people are turning out to be extremely underdeveloped and unable to run these businesses. And when he said that, it really struck a chord, because he's right. And he was also saying it just got even more exacerbated in this era of remote work, because now there is even less opportunity to mentor and to coach and to talk one-on-one. And people think, that this is a boon, and it's not. We are going to deal with also the aftermath of an entire generation of highly underskilled companies, because the executive and senior leadership and CEO ranks of many of these companies are not in a position to win. The upper bound is that when rates were zero and governments were printing money more than they could get their hands on, the top 5 tech companies represented a quarter of the S&P 500, but there was a pretty steep fall off, and everybody else represented the next about 10% of the market cap. So the point is that we had bounded outcomes when rates were zero. The average market cap of a successful company was around $3 or $4 billion. So I'm not going to judge this company at all, and those investors are very smart investors, Lightspeed and Coatue. What I will say is, at the end of the day, there's a terminal buyer of these companies. And we had a period of time that we can look back on to understand that when the party is absolutely rip-roaring, the alcohol is free, it turns out that it's hard to be good at anything. Insert the blank takes tens of thousands of years of practice. In investing, I think what I have learned is that it's very easy to get caught up in the mania. I've also learned in the last decade that we really benefited from zero interest rates. It was a tide that lifted all boats. And I have learned how to think about correlation and the difference between alpha and beta, and how to construct portfolios that I think can be all-weather portfolios. To Friedberg's point, those are nuanced, long-tail skills that you'll only take up if you're really passionate about the craft. It's not dissimilar to a person, I'm just going to use golf as an example, who learns how to hit a fade versus a draw, and who learns how to really manipulate their wedges in very specific ways. And these are all long-tail skills that come in when you decide you want to master something. And it's just important to note that mastery is required to be really good. Because otherwise, there'll be times where you'll go out on the golf course and you'll crush it. But then, there'll be other times, and most other times, where you can go and get run over, because it's hard. So that's my only comment, is that this is like everything else. Last 20 years, we blew through a debt to GDP that was, I think, 57%, and it basically doubled. And David, to your point, when we wanted to feel prosperous, what we did was we financed it. Right. We went out and we put out a ton of debt in order to make sure that our entitlement spending or our defense spending or whatever the things were that we needed as a population to feel like we were growing and moving forward as a society we had. So that is the practical nature of what happens. And look, a lot of people think that there is some upper bound to debt to GDP. And I'm actually of the opposite view, which is I think that the quote unquote invisible hand justifies us moving debt to GDP to higher and higher rates. So the first time the United States went past 100%, we thought it was the end of the world. It turned out it wasn't. We'll eventually go past 200. Somebody will clamor and be anxiety riddled, but they'll take some SSRIs. They'll be okay. We'll keep moving forward. Then we'll get to 300%. We'll keep moving forward. So we are in a debt spiral that is a feature, not a bug, of how democratic societies work. As a companion to that, I do agree with you that taxation is a pendulum. It ebbs and flows, and we're in the part where it's going to go higher before it goes lower. But I want to tell you a story, which is that in the beginning of this fall, I was in the Middle East and then I was in Asia, and they have very different taxation schemes, right? And many of them have zero corporate gains tax and sometimes zero income tax. But then the opportunities for them to be able to invest and drive returns is also commensurately lower, meaning there's not as much alpha in most of the opportunities that they see. Whereas if you go to California, you have to pay 60% tax, but then you could be an angel investor in Uber and all of a sudden take 25,000 and turn it into 100 million, which is ungodly. It's incredible. So I think that, in my opinion, there's actually this beautiful symmetry where even if taxes are high, your earnings potential is commensurately higher, such that the net that you're left with is the same as if you were in another place where taxes may be zero, but you're just not going to get exposed to the same ways to make money. And I think obviously there's corner cases where that's not true, but I don't think sweating taxes is a really important waste. It's an important way to spend somebody's time.